Hello, friends. Hope you're doing well. So today, I want to talk about some more investing stuff. Some investing ASMR investing. Today, I'm going to talk about trading options. And so, a couple precursors. Obviously, do not put money in the stock market. You cannot afford to lose, because eventually you will lose sometimes. It happens. This is not also meant to be a super in-depth. This is just kind of like basics, just getting started. I'm not like a super expert at this stuff. I've just been doing it for a couple months now, and I've done pretty well. And also, as a precursor to that, what you will need to get started, you will probably want to have about $2,000 at least, because when we're buying and selling options, on the basic side of it, everything is done as a contract. Each contract is 100 shares. So you will need collateral to do any of this options trading, which means you will have to be able to afford 100 shares, which means if you have $2,000, you can afford to sell one contract on a stock up to $20 worth. So you kind of see that, like, if you don't have a lot of capital to play with, it's kind of hard to trade options. You can get in with as little as like $1,000. There are some okay stocks that trade under $10. But obviously more is better. Once you get to like 10,000, that's kind of when things open up a lot more, and you could actually expect to get a reasonable return. So case in point, and again, not financial advice. I'm kind of an idiot. I don't really know what I'm doing entirely, but I've been doing okay so far. Recently I had some good luck with GameStop, if you followed that whole drama, and was able to get a couple $1,000s, which brought my working capital up quite high. And so now I'm trading in a stock that trades for like $90 a share. And so each option contract costs like $9,000, or it takes $9,000 worth of collateral to be able to play it. But in return, the premium I get is about $100 a week. So you could see, like, if you had $20,000, you could maybe make an extra $200 a week. But we'll get to that. We're getting ahead of ourselves. The main thing is, you probably gotta want about at least $2,000 to get started. So let's start from the beginning. If you're new, if you're fresh, options, what are they? Well, when we are buying and selling options, we are no longer buying and selling the stock. We don't care if it goes up or down, because we can make money either way. What we are doing is we are selling opportunity. We are selling opportunity for someone to sell the shares to us, or for someone to buy the shares from us. Now, so this essentially comes in two flavors. We have calls and we have puts. And you can buy a call, you can sell a call, you can buy a put, you can sell a put. So when would you do these things? Well, calls are for when you think the stock is going to go up. So if you think a stock is going to go way up, you would buy a call. Essentially what you're doing is you're buying the opportunity to buy 100 shares per contract at a set price. This is known as the strike price. And for that, you pay a premium. Now, inversely, if you think the stock is going to go down, especially maybe if it's going to go way down, you would buy a put. And this is kind of the opposite, in that you are, God, puts always confuse me. Buying the puts, because I never buy calls or puts. But essentially, buying a put is the opposite of buying a call. You think the stock's going to go down. That's all you really need to know. But we're not going to mess with buying calls or puts, because you are in those scenarios paying premium and hoping the outcome happens that you want to happen. We don't want to do that. Instead, we want to sell the calls. We want to sell the puts. Now, And the way to think of that is I am selling the person who has at least 100 shares of the stock insurance. I am saying, hey, I think your stock is going to stay the same or go up. And they go, well, I'm not so sure. And I'll go, would you like some insurance on that? And they'll go, okay, if it goes below this certain price, I will buy those shares at this price. That's called the strike price. And for that, the person pays me premium. Okay? So, how can this play out? Well, we set an agreement date. That's called the expiration date. Now, if the stock goes below the strike price at any time between now and the expiration date, they can exercise the option. Most of the time, people let the options go all the way to the expiration date, and then whatever happens is going to happen based on that. So, but just so you know, if any time, if it goes below that strike price or above the strike price with calls, they can exercise and they can either make you buy the shares or take the shares away from you. Okay, it happens. So, with the put, we are selling insurance to somebody who owns the shares. Now, how this can play out is if the shares go, the stock price goes below our strike price, you will be obligated to pay for the shares at the strike price. Okay? Now, if the stock does not go below the strike price, you do not have to pay you do not have to buy the shares, and you get to keep the premium. So the goal with what is known as a cash secured put, you are selling a put with cash. So you'll have to put collateral up, and your brokerage will take that collateral and hold on to it to make sure you're good for it. So you could do that, right? And the goal is to always bet below what you think it's actually going to end up at the expiration date. Now, if you happen to get what's called assigned, this means that the stock price goes below your strike price and you are forced to buy the shares, you will turn around and sell what is called a covered call. That is pretty much the opposite of selling a put. This is you have 100 shares and you're going to somebody and you're saying, hey, I don't think these shares are going to go up. And they go, I'll bet you that they will. And they will pay money for a lottery ticket, essentially, to buy your shares at a lower price. And if the stock price goes above your strike price, then they have the option to buy those shares from you, and they will be called away. Covered call. So that's how the wheel works, is you will sell a cash secured put until you get assigned, and the goal is just to sell those cash secured puts, right? Just keep selling them, just keep selling them, just keep selling them. Eventually, you will bet wrong, you'll get assigned, and then you sell covered calls. And the goal is to always set the covered call strike price above what you got assigned at. So, for example, if you are selling these cash secured puts, on a stock, and your strike price is $10, when you do a covered call, and you get assigned, so you'll have to buy 100 shares at $10 for $1,000. So now you're holding 100 shares. And so now you'll start selling covered calls. You'll want to make sure the strike price on the covered call is at least $10, if not like $10, $50, or $11. So that way, you will have made premium selling the put, you will have made premium selling the call, and you will have made premium on once the shares get called away. Because if you got assigned at $10, but you sell at $11, you're forced to sell, you get called at $11, you made $100, right? So you make income 3 times, triple income. So, that's the wheel, and that's options trading, kind of in a nutshell. I got some more notes though. Let's go through them. Yep. Let's grab the wheel. Let's go to the last page. Okay. So here are, excuse me, got a little froggy. Here's some lingo you might find useful. Sorry, we're just real froggy. I don't know why. Okay, so here's some terminology you might find useful. ATH means all-time high. Generally speaking, you don't want to do stuff with things that are at all-time highs. Earnings. This is when, at 4 times a year, companies will report their earnings. Around this time, you don't want to play with options because things can be very volatile and it's very unpredictable. There are times where companies will have a very good quarter and the stock will still go down. You know, it's best just to not play stocks around their earnings. You just wait that time out. ITM/OTM. This is in the money, out of the money. This essentially means is the asset already above your strike price or below your strike price, depending on what's relevant. So sometimes there are reasons you would sell a put that's in the money because you think it's going to go down, and if it's in the money already, the premium is usually a lot higher. So we don't want to. We usually want to stay away from that, but there are reasons to do that, and it's a gamble. To sell a naked call or a naked put means you do not have the collateral. So if you're selling a naked call, you do not own 100 shares. This is super dangerous, and chances are your brokerage will not allow you to do this. Okay, you'll have to sign up for options trading, and you'll probably just get like options trading 1 or options trading 2, and they won't let you do that stuff, which is fine because you don't want to mess with that because you can get in some real trouble real quick. And if you're ever on any of the investing terms, there is something called an FD. This is a pejorative term for a very far out of the money option. So again, if we're saying like it's a stock that's trading at $10 and someone is selling this option for $20, but it's really cheap, and it's usually expiring pretty quick, so it has to go up very high for you to succeed with it. That's what an FD is. Essentially, it's a very low probability chance, but it's usually low cost too. So a lot of people will YOLO. They'll put all their money into these FDs. And the reason why it is named as FD is because you will always get penetrated in the rear end. We'll put it that way. So you might be able to guess what FD stands for based off that. Pejorative terms, pejorative words, we don't like to say them. So, I think that's all the lingo you really need to know to get started. There are other ways to trade options. There are debit spreads, credit spreads, iron condors, that stuff. Poor man's covered call would be another one. You don't really want to mess with stuff. If you're watching this video, just kind of forget that stuff for now. Just start with options trading, and probably I would really highly recommend you start by using simulators. There are simulators out there where you can simulate options trading, so don't get in, without running some tests, without doing your due diligence. So let's talk about some rules and some tips. Rule number 1, the most important rule: do not, under any circumstances, put money into the market you cannot afford to lose, completely lose. With options trading, especially if you are doing the wheel, if you are selling, it's kind of hard to lose money. You might end up bag holding, which means if your put option goes very badly, you are dramatically overpaying for stock, but you're still getting some stock, and as long as the company doesn't go bankrupt, you can still sell calls and eventually dig your way out, okay? That's a little game I like to call cost basis golf, but that's a joke that you'd have to understand more terminology to get. So forget about that. But it is, in theory, you cannot lose money as long as you never sell your calls. You might end up holding a stock for way longer than you ever wanted to, but you won't lose money on the paper, which is kind of the goal, right? So that's the most important thing. The second most important thing, and I cannot stress this enough, only sell options on stocks you want to hold long term. Because like I just said, if you are chasing the premium, because there are stocks that have crazy premium, and you're going to be very tempted to get that quick win. But if that stock tanks, you will be holding the bag and you will lose money on it, and it will absolutely burn you. So, a case in point, GameStop. If you sold a put at GameStop when it was at the high at $300-400, within a couple days it went down under 100. Like, you would have lost a boatload of money. So unless you really like GameStop, do not trade on that, okay? So think about, and when we say long term, we mean at least 1 year. So you do your research. Think like, okay, will this still be a good stock a year from now? Those are the companies you want to trade options with, okay? And if you don't follow that rule, and if you chase premium, it will eventually catch you and burn you. And I did it only one time, and that was enough to learn my lesson, because I did it once, and I made like a crazy premium. I think I made like $200 or $300, and I was like, sweet. And then I rolled that option the next week, and it was even. It felt like an even safer bet. And you know what happened? I lost $600. That includes the $200 or $300, whatever, from the week before. So it was like an $800 down, just poof, in a week. It just dropped like a rock, okay? So don't do that. Only trade with companies you know about. Do your research. Make sure they're good companies. Make sure they've got good earnings. Make sure they're in good standing. Make sure they don't have too much debt. I'll do another video in the future about how to pick the actual stocks that you want to do this on. But for now, think safer stocks, things you know. Look at how their trend lines have been over the last couple of years. If if a stock has been trading pretty consistently between, $10 and $12 for the last like 2 years, chances are it'll probably stay in that window. And so even if you lose on your option play, you can guarantee you're not going to lose too hard, okay? So there's that. Some tips. Sometimes it is good to be assigned. So case in point, there are often times where the premium on the put, the first part of the wheel, will be so good that the stock will go below the strike price. So you get assigned the shares. You're forced to buy the shares, but you get 100 shares. You have to buy them, obviously. But the premium's enough that you're still getting the shares below cost. So you're getting a discount on the shares, which again, this is why you only want to do it on shares you want to actually own. So you get the discount, that's great. Another reason might be if there's a dividend payment coming up. If you get assigned, you could play a little riskier, get a little better premium, get assigned, but still be above your cost basis, so you get the discount. And then you collect the dividend on the 100 shares, and then boom, then you're off to the races with the covered call. So 100 shares with a dividend, a lot of times, that's not something to sneeze at. That's usually some pretty good money. So those are some situations where it's good to be assigned. And if you don't understand what dividends are, that's a whole other video. But if any of this is going over your head, drop some comments, because I want to do some more ASMR investing videos, and I need to know where my gaps are, because I can explain it all day, but like it makes sense up here, but what's coming out might not be what I intend to come out. So I want to help you. I want to get you investing, because if you're not investing, like, again, it's like a game is being played. Whether you like it or not, you are in the game. And if you are not investing, that is still a move, and it will always be a losing move because of inflation. Your money will always lose value very slowly. So you want to get invested. You want to get invested as soon as possible. This option trading stuff is a little risky. I'm going to say that again. It's risky. There is unlimited downside to this, okay? If for some reason a scandal happens, or the stock like GameStop drops $200, you will be effed. So be very careful with this stuff, okay? It's dangerous, but if you do it right, if you do the research, if you do your work, okay, it's really not as much work as you think it is. You can learn how to do this in a weekend. You can research stocks in your spare you make the plays, and it's like once a week or once a month, and you're good. You can make a little bit extra money, and over time that adds up very fast. Okay, so you want to do this. It's good. Trust, it's not that scary. Let's see. What else? So again, a fun game. I was talking about cost basis golf, is what I call it, is after you get assigned on your put. So you sell a put because you think the stock is going to go up or stay the same, and it doesn't happen. You get assigned the shares. Now, what a game I like to play is called cost basis golf, and what that means is whatever you got assigned at, that is your cost basis. So if you sell the put at $10 and the stock goes down to $9, you have 100 shares at $10. Okay, so if you could sell 10 calls for, $100 each, right? If you can sell the calls and not get your shares called away 10 times at $100 each, which is probably really unrealistic, but just for the sake of example, then you will have brought your cost basis down to zero. Essentially, you have gotten free stock, which is awesome and fun and cool. And then you'd be like, they paid me to take the stock. I am a Jeff Bezos. So that's a fun game. Another thing is to take a percentage of each of your premium wins and invest it into safe plays. Okay, if you're winning and you're doing good, the temptation is to continue to roll it out, keep rolling, keep playing, but we're in a bull market right now, so while my things are going good, they will continue to go good, but eventually the chickens will come home to roost and I'm gonna lose hard. Okay, it'll happen. But if you're always profit taking, if you're taking a percentage of those premiums, if you're getting $100 a week in premium and you're taking $10 off and you're going to invest it in blue chips, your long-term financial health, you should be okay. Okay, hedge your bets, be safe with this stuff. Okay. Another super important thing is do not forget about taxes. So if you're making $100 a week, that's considered short-term capital gains, and you will be taxed at your tax rate. For me, that's 30%. So if I make $100 in a week, I better take 30 of those dollars and put it aside because Uncle Sam's gonna come wanting it come tax time. Okay. And so if you're making a lot of money, that's great, but eventually you will owe taxes on it. So don't withdraw it and then go spend it, because the government knows how much you made and they want their cut, and they're real jerks about it. And the last time, two more tips here. You can, oftentimes, if you're selling options, you can buy to close. There are reasons you want to do this. So sometimes, so you'll get the premium up front, right? So I sell a cash secured put. I will get the premium up front, okay? Cool. But the value of that option can go up or down. And so what happens is, over the course of the life, as it gets closer to the expiration, the value of it might get so low, like that it's definitely not going to happen, right? So if I sold, for example, an option on a stock that's trading at $90, right? And I get $100 in premium, and the expiration date is Friday next week, and the shares just go up and up and up, the value of that option will go down and down and down and down, and I can buy that option back for much less than I paid. So, for example, I did that today. A stock that's trading at $90. I put my $9,000 collateral in. I got $100 in premium, right? And so if Monday happens and that stock has gone up like $10, the value of that option will probably have sunk by 50% or more, and I can buy it right then and there for $50. When I got paid $100 to take it, I could take 50 of those dollars, buy it, close that off, and roll that position out. And sometimes that's good to do, especially if the value drops really quickly and you can make your money back and then go open a new one. A lot of the time, it's better to leave money on the table, especially if it happens quickly. Because if you can get 50, 60, 70% of that value in 2 days, then yeah, why hold it for the rest of the time just for that last 30%? not stress about your money in the market, which is great. A lot of people like doing 30 to 45 day expiration because then there's more time. And time is a good asset with options because the stock can go up and down. And in that last week, there's what's called the Greeks. Those decay pretty quickly. So volatility is way up because there's less time. And so if the stock starts moving against you, there's less time for it to correct in your favor. So the two ways to do it are the riskier way, which I do, is to sell Monday for a Friday expiration. Or the safer way, which pays less but is safer, is to do 30 to 45 days out. And when you do the 30 to 45 days out, you're looking to get at about 50 to 60% of that premium, and then you close it off. And so that way you're never getting assigned. Sometimes it will still happen, but generally you won't be getting assigned. You're always making that premium, and then you're just rolling out the next one. And if it doesn't work out, you just keep holding and hope things come around for you, and you might be able to hit the eject button for less than it would have cost you in the loss. So that's pretty much it. What you want to do is you're going to have to figure out, depending on what brokers you're with, you'll have to get approved for options trading. Robinhood makes it pretty easy, and I got that without much issue. Other platforms, I like Robinhood a lot, okay? I'm not trying to shill for Robinhood. This is not sponsored by Robinhood. The user interface is very simple, okay? They make it easy, and they make it easy to understand. So, case in point, let me pull up my Robinhood here. And we are going to go to Coca-Cola, okay? Because that's a good blue chip stock. And you can see if we go, 1 year out here on Coca-Cola. Let me bring it closer to my face. Let's zoom in. Okay. So aside from when COVID happened, that's the dip. We can go out to the 5-year chart. You can see it's been pretty consistent. Okay. So we'll hit the trade button. And we go trade options. Okay. And so it's asking. Let's get it in the frame. Oh, reflecty. Can I see it? Can I see it? Let's see it. There we go. So I think I'm going to try this backwards. I think it's going up, right? And so up here, these are your expiration dates. So let's go ahead and just click on one. And so you see we are selling a put. That's what it's set to, right? So focus it in. I just gotta get this. Okay. Hopefully you can read this. And so that way I can see what I'm doing. So we're gonna go, the current price is $50.63. So let's go something kind of conservative. Let's say $49.50. So as long as the stock stays above $49.50, we'll profit. And as you can see, it says chance of profit. It's not the most accurate thing in the world, so don't take that as gospel. But in my experience, anything that says 70% is usually pretty good to go. Sometimes you still get burnt. It happens. So we're going to click on that, and it says right here the premium is 80 cents. That's 80 cents per share. And remember, we have to buy 100 shares. So we'll get $80 for that. So we'll go into that, and we'll hit one. We'll say minimum credit $80. And so it will take $4,950 for you to make this trade in buying power, and it will take that and hold it as collateral. Okay, so you need to have $49.50 to do this, and if you do that, you'll get $80. And then you hit review, swipe up, you're done. That's it. That's options trading. It's really not that scary. It's pretty simple. You can make regular-ish money with it. So far, I've been doing okay. But again, that's like 4 or 5 months, and it's been a very good bull market, which means things tend to go up. Everybody looks smart in a bull market. So, take that for what it's worth. And that's If you have questions, drop them below. If you're enjoying the investing talk, either because it's very interesting or because it's very boring and it puts you to sleep, I'm here for it. I will nerd out about this stuff with you, and I want you in the market. I want you investing. I want you taking care of your financial health, because believe me, once you have a couple of those wins, A, it gets a little addicting, but B, you start to see, like, oh, if I could get, an extra $100 a week, like, how does that affect your life? That's like an extra $400 or $500 a month. For a lot of people, that is their rent, that is their grocery, that is their car note. This has the power to change your life. If you can understand it, you can learn how to do it, and you can tackle it with a disciplined, manner. Okay? So I hope you're doing well. As always, if you found this video useful, hit the like button. If you're new here, please subscribe. Put out new videos most days. Yeah, I don't do a lot of investing videos, but I'm gonna do more. Maybe, I don't know. We'll see. See how these go. Yeah. So I hope you're doing well, and if not, well, I hope that turns around for you. So with that said, thank you so much for watching. I will see you next time.